JP Morgan's Jamie Dimon recently said earlier this month, he warned of an economic hurricane that's coming our way. What is your outlook for Citi of the economy, given that the inflation is at a record high and the Fed is expected tomorrow to announce another interest rate hike? What are your thoughts?
Yeah, sure. Well, look, I'm not in the business of meteorology or predicting the weather, so to speak. But what I will say is we are continuing to manage through a period of uncertainty. And if you think about it, Nina, that's persisted now for a couple of years. It's more from a pandemic to unprecedented levels of stimulus to managing through that to now an environment where we're dealing with the prospect of significant increases in rates, the Russia-Ukraine war, and the prospect of a recession. So we're all managing through an unprecedented amount of uncertainty here and now. And just last week, we saw significant increases in the CPI and in inflation. That was met with, I think, an investor sentiment that the prospect for higher rates would come a lot sooner and even more so than what the Fed talked about just a month ago. If you look at the market today, we're looking at a rate increase that could be as high as 75 basis points in the next two meetings. We'll know more about that tomorrow. But when you look at kind of how that plays out over the longer term, it does seem as though the investor sentiment is for a pull forward in that increase in rates as opposed to a long-term heightened level of rates beyond what the current or the prior forecast had suggested. Again, we'll know more about that tomorrow, but I think what you see here is the sentiment that the Fed is going to have to do something more to try and starve off the high levels of inflation that we're seeing and to try the best that they can to ensure a softer landing, so to speak, as we manage through what will likely be some type of recession.
What do you see when you look at your consumers? How do you assess consumer health when you were looking at financial health with Citi having a big consumer-facing business? What do those loan books tell you?
Yeah. So what do you do kind of when you deal with periods of uncertainty like the one we're in? You obviously look at your book as you've described. You plan out all types of scenarios to be prepared to manage through those. As we look at our book, both the corporate client base as well as the consumer client base is very interesting. The balance sheets remain very strong on the corporate side. Liquidity levels remain very strong and robust on both the consumer and the corporate side. We're seeing continued spend levels on the consumer side at heightened levels. We're seeing recoveries in certain sectors that were significantly impacted during the pandemic, like travel and dining and the like. We're seeing very low levels of any concern in the way of cost of credit. Our net credit losses for consumers in our branded card business was 1.5% in the fourth quarter. That's very, very low, and low as well in our retail services part of the business. So the consumer remains quite healthy, I would say. But I would also say cautious as we think about what a recession could mean as we see the higher gas prices and other inflationary aspects kind of play through. I think there's a cautious sentiment as to what that could mean for the consumer long term. But labor markets as well remain very tight, but we are mindful of it and watching it very closely.
How is that if you're thinking about your corporate clients? What do you see them doing? We've seen a lot of U.S. businesses refinancing debt in expectation of higher rates. What else do you see corporate clients doing as we're entering this prolonged phase of more uncertainty as to where the economy is going to go?
Yeah, again, top of mind for all corporate clients that we're dealing with. Our client base tends to be the more investment grade level, large multinational clients, but we're also covering commercial middle market clients. Again, balance sheets are very strong, shoring up, of course, the liquidity positions that they have. Lots of dialogue around the supply chain. If you think about the supply chain dynamic, it's impacted not just about coming out of the pandemic and that mismatch between demand and supply, but also the recent Russia-Ukraine dynamic or war is playing out on that. Energy and commodities is playing out on that supply chain dynamic. So a lot of discussion with clients on that, and we're uniquely positioned to assist them in that area. If you think about our Treasury and Trade Solutions business, where we're in over 90 countries covering these large multinational clients, we're right there at the table talking about how they might shift what their supply chains look like and what those flows look like. And we're there to support them in their working capital needs on the ground as they manage through this period of uncertainty. So lots of dialogue there. I know our clients are also focused on their expense base and what inflation could mean for wage increases and product input increases. And so those are all topics that I know are top of mind. But we're all kind of thinking through and planning for different scenarios, just given, again, this mix of inputs being very different than anything many of us have experienced before.
You mentioned the situation in Ukraine, Russia's invasion of Ukraine, which is also is bringing changes for your operations in the country. Where do those plans stand to dispose of your commercial operations in Russia? Can you share a little bit where those discussions stand, and also where you could potentially find a buyer?
Sure. Well, look, we really tried to get after and get in front of some of the issues in the Russia-Ukraine war early. And that involves both how we deal and assist the clients that we have on the ground there, and equally important, more important in many instances, how we help and assist our employees who are on the ground covering off those clients and ensuring their safety and well-being through all of this. At the first quarter, we talked about our exposure, in Russia to the tune of $7.9 billion, coming down from the year end at north of $9 billion. And so we've made significant progress in reducing our exposure and working with our clients to pay down that credit exposure, which has been very important, obviously. We continue to do that. We continue to reduce the credit that we have in Russia. In some instances, that results in a mix change in our exposure as clients pay down their debt. That results in cash at the central bank. But we're actively managing, ensuring we can reduce the risk of loss and exposure that we have in the country there, and have done so, and we'll continue to do that. As you mentioned, Russia was one of the 13, now 14 consumer markets that we mentioned last year that we would be exiting. We have continued to work on the prospect of a sale of our Russia consumer franchise, and expanded that to include our commercial business in Russia as well. We obviously want to do that, and will do that in a way that is consistent with complying with rules and regulations as it relates to what we can and cannot do, and sanctions that are in place. And those dialogues continue, and that's probably as much as I can say at this point. But it does remain an important priority for us.
When you say that the dialogue continues, what is the timeline for this? Can you give us any sense as to when you expect this business to be wound down? And also, can you share any more about funds that are currently held in Russia? Do you see any chance of being able to repatriate them out of the country at some point, or is that just going to result in a loss and a write-down at some point?
Again, I'd say, first of all, we're pursuing the sale of our Russia business, not a wind down. And it's the Russia consumer and commercial business that we have there on the ground. I can't say a whole lot about the timing of that. As you can imagine, it's a very complicated process in the midst of everything that's going on there. But it is something that we're in active dialogue around, and we'll continue to kind of update folks as that progresses. And I'll talk more probably at earnings about how the exposure evolves. But what I will say is I talked about at the last earnings call, the risk of loss coming down in the case of a worst case scenario, risk of loss coming down meaningfully to $2.5 to $3 billion or so. And we continue to work that down, and we'll continue to do so just as a prudent risk management approach to our presence on the ground there.
You mentioned the plans to exit various countries as a bank. You have embarked on a big technology transformation program. Tell us a little bit where those plans stand and where the bank is making progress. I've heard from investors on various fronts sort of a little bit of disappointment that things are not moving faster, given that this has been one of several efforts at the bank to revamp your business. Just wondering where that stands.
Look, we're making good progress there. I think we've talked about a couple of things as a bank. We talked about our strategy, and we just had an investor day in early March where we talked about our vision, our strategy for the firm. We talked about that in multiple phases and getting to return levels, improve return levels over time. And part of that message included investments that we have to make in our franchise that are critical to the long-term sustainability of the franchise, and those investments included investments in our front end, business-led investments in parts of the business where we have a significant competitive advantage, like our Treasury and Trade Solutions business, like our wealth management business, and the like. And we also talked about investments in our transformation, where a core part of that is in response to the consent order. But it goes beyond that towards how we modernize our bank and its operations and how we ensure that we have a safe and sound institution with an appropriate level of risk and controls. And that ranges from investing in systems and technology, improving data, improving our compliance, improving risk management, et cetera. All, I think, fundamental necessary things in order for us to maintain competitive strength where we have it, and as I said, deliver for all stakeholders. And so we're making good progress on that. At Investor Day, I talked about that spend, those expense levels kind of peaking, towards the medium term as we get to higher levels of return and starting to pay benefits post that period of time. And I'd say we're on track for that. When I look at the spend level this year, I also gave guidance around the expense increases that we expected. In the first quarter, that was 10% of an increase year over year, ex divestitures, and we hit that target. And so we're making good progress on this. But this is important. This is one of those areas where, despite many of the challenges that industries will face in the environment that we're in, you want to maintain the investments that you have to make. These two areas of business-led, which shore up your competitive advantage, as well as transformation, which prepare you to operate more effectively and more efficiently, are areas that I feel very strongly about protecting as we manage through some of the uncertainty that I alluded to earlier.
I want to follow up on the consent order just in a minute, but just coming back to investors, just looking at your share price, it's down sort of between 25 and 30% since the beginning of the year, which is in line with the market, but then also or with parts of the market, but it's also down about that compared to 5 years ago. What are you doing to boost investor confidence in the company's strategy and convince them that what you're doing is working?
Yeah, I'd go back to what we talked about at Investor Day, and really being, a preeminent institution for our institutional clients and providing them with the global products and services and needs and meeting the needs that they have. And when you think about that, we talked about 5, core segments of our business. We talked about services, which includes our Treasury and Trade Solutions business. We talked about the security services business within that same services segment. We talked about markets, where we have a number 2 franchise in fixed income and a growing equity markets business. We talked about banking, all on the institutional client group areas of growth for us. And on the personal banking and wealth management, we talked about U.S. personal banking and wealth management, an area where we think there's significant growth and opportunity for us. And so when I think about that focus now on these 5 core areas of our business, and the decision to exit those other 14 consumer businesses, that's a big part of how we narrow the gap in returns, change the mix of our businesses, and ultimately drive down our cost of equity and improve the stock price that we have, capturing the linkages and connectedness across those core areas. And then the investments that we're making And those investments, again, will start to pay dividends and returns over time. And then how we deploy our capital, optimizing our capital towards the growth areas, the areas that are higher returning, and returning it to shareholders, particularly given where we're trading, obviously, over time. And that combination of things over the medium term, we call it 3 to 5 years, should allow for us to go from what was a roughly 9% ROTCE, return on tangible common equity, last year, adjusted for reserves, to more of an 11 to 12% return on tangible common equity in that medium term, and then higher long term over the longer term.
Which is, of course, still significantly below what competitors are making and are targeting. Just coming back to the consent order, you mentioned that earlier. That was, of course, something that for many years impacted your business and was lifted earlier this year after the bank made improvements in terms of its risk controls. I just wanted to follow up on two incidents that I remember, like the recent wire of about 900 million to Revlon in 2021, and earlier this year, this fat finger incident in Europe, which resulted in a European so-called flash crash. Just wondering, like, given that the consent order is no longer in place and the bank has made changes, how come that those things still happen?
Yeah, well, I want to be clear. The consent orders that we received a year or so ago are still in place, right? The consent orders around the areas that I mentioned, like controls, like risk management, like compliance, that those two consent orders that we received, one from the Fed, one from the OCC, are very much still in place. And the transformation that we're talking about is designed, and now we're executing against that design, to address the heart of what's in those consent orders. And it includes, again, modernizing our operations, including our loan operations, and many of the other systems that we have in place. And so we're making progress on that. There's still a fair amount of work that has to get done over the next couple of years. This is not something that gets fixed overnight. It is a multi-year journey, and I've been clear with our investors and other stakeholders about that. It will and does require investment, and we're making that investment. We will see progress along the way and risk reduction along the way, and we'll be very transparent about that. But that is the work that we're doing. Right?
Just one more question before we turn to questions from the audience. A bit of a shift in terms of topic. Citi made a range of racial equity promises in 2020 following or amid the murder of George Floyd, and also discussions here in the US about wider racial equity. Just wondering how you're assessing the progress that the bank has made, of course, you being a prominent Black CFO amongst many white counterparts. Just wondering how you're thinking about that.
Yeah, sure. So look, that was obviously a horrific event that happened, the murder of George Floyd. And in many ways, it spurred, I think, a number of institutions towards taking action, which I think by and large is a good thing. I think that from our perspective, we've made progress, but there remains a considerable amount of work to do, and I think that's true not only for us, but that's true for the financial services industry and probably many other industries as well. That there's a lot left to do. I am pleased with the progress we've made. We committed $1 billion as part of our action for racial equity, and we committed that over a 3-year period, and we got there in a little more than a year in terms of putting that to work, and that included everything from work that we're doing with minority depository institutions, work that we're doing that we've done with 5 Black-owned firms to assist us in syndicating a $2.5 billion bond issue, from which the proceeds would go towards quality, affordable housing. Work that we've done as we've stood up our City Impact Fund, where we've invested close to $90 million, with over 60% of that going towards diverse entrepreneurs, women and Black-owned entrepreneurs. work that we've done in our procurement area, where we spent over $1.2 billion in 2021, with almost $500 million of that going towards Black-owned businesses. So significant progress on that front. We've also made significant progress as it relates to representation. Representation goals that we set back in 2018 for assistant vice presidents all the way through managing director. In the case of women, we've reached 40.6%, up meaningfully, up from 37% in 2018. In the case of Black representation for the same levels of AVP to managing director, we reached 8.1%, up from 6% in 2018. So meaningful progress, a lot left to do. I point out one other thing that I think is true for Citi and hopefully true for other firms, which is that what we're really trying to do is to drive systemic change in our organization. And what that means is it really being part of our operations, our practices, our policies to ensure racial equity. And that means changing the way we think about our business model, the products and services that we offer, and we've stood up organizations to ensure that we're doing that. It means changing the way we operate and run the firm. The procurement example is a good example of that. It means managing our talent with an eye towards inclusion and towards diversity, and we've made progress in that area as well. And it means supporting organizations that are on the front line and trying to drive this change. And we do that too, and that includes higher education institutions like Howard University, like historically Black colleges and universities. And so I think it's important that we think about how we drive this change in a way that is sustainable, and that's been at the forefront of our commitment.
Can you talk a little bit about how this is impacting the finance organization specifically? Like, I would assume some of these changes, of course, are also taking place in your organization. Is there something you would point out in particular with regards to the company's finance department? On the topic of diversity? Mm-hmm. Yeah. I think there are a couple of ways. Two things I'd point to. One is when I look across my executive management team, I've made a point of making sure that we drive improved representation. And so I've got two African Americans that sit on my, as are directs to me, sit on my management team. We've stood up a diversity council, in the organization. And we've also driven how we ensure representation in the activity that we do in the market. So that bond issuance that I referenced, my treasury team, led that work with our banking team in ensuring that, or committing to working with those 5 Black-owned firms. We've made similar efforts around bond issuance activity with women-owned firms and with veteran firms. And so we're trying to do our part for sure in terms of in achieving the goals that we've set and driving the change through the organization.